Okay, we're going to go ahead and get started today on the topic of using cash or other people's money when you're fixing and flipping property. So, I interviewed 4 experienced fix and flip investors, and this is what they said about the funding for their deals. The question is that I've heard from people is, should I use my own money or borrow money to do my flip? Well, you can use your own cash for sure. That's definitely an option. There's no interest payments. You have full control. No lender is required, but your capital is locked up in this flip until you get it sold. You can use other people's money, meaning you leverage other people's capital, keep your cash working elsewhere, but it costs money to borrow. And when I say other people's capital, I mean private capital. You're looking for private money lenders, which is doable. We can talk about that. Or you're using institutional money and institutional lenders, and we can talk about that as well. But I interviewed 4 real estate investors who have done it both ways, using their own cash and using other people's money. And here's what they said. This is just a summary to get us started, and we'll dig in a little bit deeper. But these are 4 real people in my circle, and they have different backgrounds. They come from different states, they come from a different mindset. So they're not together networking necessarily with each other daily to have the same mindset. So keep in mind, these people are coming from different areas of the country, and these are the real results that they've experienced. So I interviewed Michelle Winberry. She was nice enough to give me some of her time, and she explained that her and her husband started with cash only, and they would use cash, but over time they scaled up and started using other people's money. I interviewed Richard Gamble. He has 15 years of experience. Him and his wife, they've done hundreds of deals, and he is an other people's money advocate. But we'll get into some of the things he said in just a minute about using your own capital as well. I interviewed Richard and Coco Barron. They have an interesting story. They're active fix and flippers, and they started out making $14 an hour, just were working regular jobs, and they are proof that it is possible to start a flipping business and be successful. And then I interviewed Matt Gerace, and he's a cash first thinker, and he had a very balanced voice about it. So we'll get into what he said. Michelle said, I started doing flips with my own money and it worked, but it was slow. Once I started using financing, I could move faster, take on more deals, and actually build something. So the key takeaway from the interview with Michelle was she started with cash only. She switched over time to other people's money. And once she made that switch, the result was she was able to scale up or build quickly. Okay. So once she switched gears to the other people's money mindset, that was when the growth in her business was unlocked. And it's not because cash was wrong, but because time and scale matter at a certain point. So if you're wanting to move quickly, she advocates for using other people's money. However, she did start out with her own cash. So you can bet on it you're going to make some mistakes when you are real estate investing in the fix and flip model. You're going to make mistakes. And Michelle's advice was she used her own money as she was learning and making mistakes along the way with that and got better and better at it. And then as she got better at the flips, then she started leveraging other people's money at that time. And it's not because the cash was wrong. Cash is great. Cash got it done. Cash allowed her time to become a better flipper and learn the things that she needed to learn. But if she wanted to grow her business, she knew she had to use other people's money, and she did. And now she's very good at that. I interviewed Richard Gamble, got 15 plus years experience, him and his wife. They've done hundreds of deals, more than 100 flips. And the big takeaway from him, once we spent a little time together and talked, was that time is the real currency. So the interest cost on a short flip is small compared to what your cash earns doing nothing. And the investor who closes fast and moves to the next deal wins. And he also figured out that speed wins because they started out using their own money and their own capital, but it was so slow, to get going. So once they decided to use other people's money and started leveraging, that let them close faster on property because they had private money lined up and could close. Um, they outbid cash flow investors. They never miss a deal. And I think the point that he was trying to make there was made the decision to keep his own capital back and off to the side, doing other things while he used other people's money to fund the deals. So if another deal opened up or a deal came along, he had enough capital to make the down payment on the next deal that came along. So he always had his capital off to the side to snag the next deal. One thing you have to understand as we talk about this, when you're using other people's money, a lot of times you're going to be using some of your own capital anyway. You're going to have to put some of your money in. Maybe it's 10% of the purchase price. Maybe it's a portion of the renovation, but you got to have some to get started to purchase a deal. So they would keep money to the side so they can move on to the next deal. Because one thing I've noticed that's really kind of inevitable, and Richard mentioned this too, is that if you have a flip and you're working actively on that and it's a good deal, or you're closing on that deal and you know it's a good deal, for some reason, there'll be other really great deals come along at the same time. So I don't know why it works that way, but it's certainly true. I've seen it happen too many times. So you've got a deal and you're working on a flip and there's going to be another one that's going to drop in your lap and you're like, gosh, this is a good deal too. I want to close on it too. Well, if you're using your own capital and say you only have enough for one flip, then you're going to miss out on that next deal. You're not going to be able to capture it when the time is right. But if you have your capital set aside and you're leveraging other people's money on your first flip, then when the next deal comes along, you have the capital to get it going and invest in that. The institutional money or your private money lenders, they may require some money down, some of your own skin in the game, if you will, like 10% or so of the purchase price or something like that. So always have your capital set to the side so you can capture the next big deal that's coming your way. And once you start doing deals, there'll be more. So keep that in mind. There's always another deal, especially once you start moving and rolling and you start experiencing that. You'll see, well, this is a good deal. Here's another good one. So keep your capital to the side for that. Your cash works in one house. Other people's money lets you run multiple at one time. So it depends on what you want to do. Do you want to move slow and just work on one property at a time? And maybe that's the case. Everybody is an individual and we have to have a conversation about it. What is it that you want? It could be that you're raising young children and you don't want more than one at a time. And I don't blame you. Spend time with your babies. Don't spend time working on a flip. You can work yourself silly when the kids are grown, I promise. But if you want to scale quickly and you're like, I want to do more than one at a time. I have the capacity to do one at a time, more than one at a time. Other people's money lets you run two at the same time, maybe three, four. I know some really good fix and flippers that are running 10 at a time, and they've got it figured out how to do that. So, the fix and flipper that's running 10 at a time or even three at a time wouldn't have enough capital to go around to do that many at once. So, see how using other people's money allows you to grow quicker. Now, Richard said Dave Ramsey is wrong here. He says that investment debt and consumer debt are not the same thing, and productive debt builds wealth. So his, personal debt, maybe Dave Ramsey is onto something, sure. But when it comes to scaling your business in the fix and flip model, leveraging other people's money and utilizing debt in a way that makes sense moves you farther faster. For example, let's say you're working a traditional W 2 job, making a median income for your area, and you're saving your capital as fast as you can to do your first flip to pay all cash. Ask yourself this question: how long would it take you to save that up? How much does it cost to do a flip in your area? Every market is different. But let's say you need a good chunk, you need $200,000 at least to pay for everything yourself. How long would it take you to save up $200,000? Well, what if you just saved up the down payment? Maybe you just saved up $10,000 and you had the down payment, you had some reserves, and you used other people's money and you were able to do a flip. You're able to go ahead and do one. Then you could do that flip, sell it, take the capital, do it again and again and again. So it allowed you to move further faster using other people's money. But Richard is a strong component for keep your ideas about investment debt and consumer debt separate. Maybe they're not the same thing. Then I talked to Richard and Coco Barron. This is the sweetest married couple. They're so sweet, and they're just killing it in their flips. And I couldn't be happier for them. But when I interviewed them together, they both chimed in. They were working for an hourly wage and $14 and $18 an hour. They had zero real estate background, and they used other people's money to get their first deal done. So using cash for them wasn't even an option. How long would it take somebody that's making $14 or $18 an hour to save up enough money to do a all cash flip? How long would that take? I don't even think that's possible with inflation the way that it is. So they knew they had to do something different. And they wanted me to point out that you don't need to be rich to get started. So you don't have to have all of your capital lined up and ready to go to get started. And you don't have to be a certain age to get started either. You can be in your teens. You can be in your early 20s, or you can be in your 50s and you're just getting started. It doesn't matter. Just get started. But you don't need to be rich to get started necessarily. So their first flip, they used borrowed capital. The deal worked, and the profit proved the model. And so then they moved on and did the next one and the next one and the next one, and they agree with using other people's money. And Coco mentioned she did say, you know, something to the effect that, I would, even if I had the cash to do their flips, and they've stacked up their capital now, they're so experienced in their flips. Like, even though we may have the capital to do the flip, I would rather have my money working elsewhere. So she's got her money in other investments, earning really nice return and other investments. So she's like, I don't even want to put my money in my flips. I want to use other people's money while my money goes out and works and does what it's doing somewhere else. And then I'm using other people's money to do my flips. And I asked them, because they were so young when they got started, I was like, how did you talk lenders into loaning to you? And they were like, well, you just have to, integrity matters. You just have to tell your lender the truth and be upfront and honest with them. And they just told me a story when they first got started of how when a contractor stole from them mid-project, they covered it out of pocket rather than walking away. And that integrity built lender trust. So what that means is they had a hard lesson to learn. And I told you you're going to make mistakes, right? Well, this was a mistake. They chose the wrong contractor, and they had a lesson to learn about that because this contractor stole from them, and they were using other people's money to do the flip. Well, they could have walked away from it and allowed a foreclosure to happen and let the property go back to the lender, and then it's the lender's problem to do something with it. They could have just washed their hands of it and walked away, or turned it over deed in lieu. They could have turned it all over to the lender deed in lieu and not have to go through foreclosure, and just said, this is your problem now, Mr. Lender, not mine. But they didn't. They continued working on this project. They used their own money out of their own pocket rather than walking away. And now that private money lender is actively funding their flips today. So they're in a partnership that is strong, and it's based on integrity and honesty and work ethic. And it sealed the deal for the lender and Richard and Coco to work together, because the lender saw, okay, these people are good people and they're not going to leave me with these properties to deal with. Because here's something that you need to know: if you're borrowing other people's money, The lenders don't want that property back. They're not in the business of fixing and flipping. If they wanted to fix and flip, that's what they'd be doing. That's not what they're doing. They're your money lender. They don't want that property. So don't go into foreclosure and hand it back to them if you can help it at all. You need to finish that project out. And it builds integrity. So as you move along, you've got more private money in your back pocket because they know they can trust you and they're going to lend to you on the next one and probably with better terms. Because lenders lend to you based on your interest rate is based on risk. How risky is the deal? How risky are you? So if your lender knows, hey, these people have integrity, they're going to take care of this project, they're going to take care of me, the lender may back off on some of the interest because they know they don't have to worry about it, that you're going to take care of them. So the lender relationship is the asset. That relationship is what makes the next deal possible. Now, Matt is a cash first thinker, and he's not in the East Tennessee market where um, Richard and Coco are. He is in Colorado, so it's a completely different market. So my interviewees are from different places, like I said. So it's interesting to see some of the similarities. But Matt prefers cash when he can. So that makes his endorsement of other people's money more credible, not less. So he is a cash thinker. He says cash gives you control. He's like, there's no interest clock, there's no lender to answer to. For smaller deals or investors with strong reserves, this is a real advantage. If you have the cash and the capital and the reserves to get it done, use your cash. You might sleep better at night knowing that you don't owe anybody on this deal and you can work on it when you want to work on it and you're not under any kind of timeline. Okay, I want to talk about that for just a minute though. It depends on the investor how you want to think about this. So Matt is saying, and he did say, and he's on the call, he may chime in here in a little bit, but Matt did say, if he knows it's his money, he's not worrying about it and he's going to work on it when he wants to work on it. And I've talked to other flippers too, and they're like, I'd rather use my own cash because I know I can go over there and work on it whenever it suits me. And if I want to take a break or if I don't want to work on it for a while, I don't have to. Sure. But the other investors that I talked to, Richard and Michelle, they said they like using other people's money because it motivates them to get it done. They know if it's somebody else's money, they're going to finish it in a timely fashion. Like they're motivated, like it gets them going, gets them up and moving every day to get it done. And they were like, well, if I use my own money, I might be kind of slow to get it done. Or I might be a little bit, I don't know if lazy is the right word, but kind of lackadaisical about it. And they like having that timeline when they know they have to pay that money back in a certain amount of time because it pushes them to get the deal done. So if you know yourself, I guess know yourself as an investor. And would you rather use your own cash and go at your own pace and not worry over it? Or would you rather use somebody else's money because you know it pushes you to get the deal done faster? Matt told a cautionary tale about his mom. A lender forced her to exit before she can convert to a rental. So when someone else controls your timeline, you lose options. And I've seen this as a mortgage loan originator. Investors come to me and they need to get that fix and flip loan paid off, and for whatever reason they can't. And the list of reasons why they can't or they can't do it right now is long. But then they're in a position where, well, how do I get this paid back off? Um, and I can't. So if you use other people's money, that is an issue. The lender is also a deal filter. If your lender will not fund the deal, that is information for you. So a good lender is a second set of eyes on your numbers. If this is a lender that funds lots of deals and you bring them your deal, you bring them your purchase price that you've worked out with the seller, you bring them the scope of work that shows what you're going to do, you bring them to repair this property, and you bring them the after repair value with comparables showing what is this property worth after repair. You bring all that to them and the lender says this is not a good deal. that lets you know, oh, well, I'm not thinking of something correctly, and I need to go back and rethink this. This is not a good deal. If you're a new flipper, I almost would recommend using a lender because they'll tell you this is not a good deal. And one way they'll tell you is, okay, here's your renovation costs. Here's your purchase price. If you want to do this deal, you're going to have to bring more of your money to the table because there's not enough spread in this when you're done on the after repair value. So sometimes using a lender keeps you from doing a bad deal. It makes you rethink your deals before you pull the trigger on them. So that's something to think about. When other people's money makes sense, according to Matt, would be bigger deals. And this makes sense, right? Like if it's a really big deal and you don't have that much capital to leverage somebody else's capital, whether it's private money, bank, institutional money, whatever, that's necessary to get those bigger deals done. Or you want to use other people's money when you've got faster timelines, or when your reserves are better kept liquid. Matt uses the other people's money strategically, but not automatically. So for him, it just kind of depends on the deal. Um, I want to talk about reserves for a minute though, because I've seen this happen as a loan officer. You have flippers and they went over on their project, and you're going to go over on your projects. You can write that down. It's going to go over. Something's going to happen. Something you didn't see is coming. Murphy's going to show up. Okay. It's going to be more than you think. So you have to have your reserves to the side to meet that when it happens, to be able to fill the gap and pay for, you know, when Murphy's Law happens. You got to dig a well. It's got to be, this is a true story. It's got to be deeper than you ever thought. And it costs twice as much to dig that well as what you put on that scope of work. Well, who's going to pay for that? Your lender's not going to come back in and give you more money most of the time. So you got to have the reserves to pay for that. Okay. I've also seen people that use their credit cards thinking, okay, I'm going to flip this property and pay my credit cards off. And the repairs are on my credit cards. Be very careful with that. It would be better to have your reserves to the side to pay for your overages than the credit cards. And if you're using your own money, but what that really means is when you say you're using your own money is that you're using credit cards. I will caution you strongly about that. And I get it as an investor, and I've done it. I've done all these things and made the mistakes and tell you all about them. But when you do that, and then it takes longer to flip it, it takes longer to sell it than you think, and your credit card is racking up interest. Now, that may be just factored into the deal. You're like, I know I'm going to pay this interest on my credit card, and I factored it in. That's one thing. But when you did it, and that interest is eating into your profit, it could eat up all of your profit or close to all of your profit. So be careful about that. And it lowers your credit score. So if you're thinking about refinancing into a debt service coverage ratio loan and keeping this property as a rental, but your credit cards have tanked your credit score, then you either can't get a DSCR and you're forced to flip it, or you're going to have a higher interest rate because your credit is lower than it should be, or you're going to have a 60% loan to value cash out option than an 80% if your credit score was good. So I would say always protect your credit score and be careful about those credit cards. Another thing that happens, and I see this all the time, and I've done it myself, is you accidentally don't make a minimum payment on a credit card, or you accidentally miss that payment. Maybe you had it set up on auto pay, but the credit card company turned off your auto pay. I don't know. There's all kinds of things that could go wrong that doesn't get paid, and you're busy laying flooring. You're not paying attention to when is my credit card due, when is my payment due, and then you have a missed payment on that. So when that happens, you got the extra fees on the credit cards, which is one thing, but also that dings your credit score and makes your credit score go down. And remember, you don't want that to happen, and you want to keep business and personal separate like that if you can anyway. So the honest case for cash, I'm not saying either way, one is better than the other. And really, neither of these investors, I think they would all say, it depends on you and your mindset and where you're at in life and what you would like to do. But these are real advantages, and I'm not dismissing them. Nobody is. This works every time. Cash works. Okay. Zero interest cost. Every dollar of profit stays in your pocket. No interest clock ticking while you renovate and wait for a buyer. And talk about some stress when you've got a property, a flip on the market, and the buyers aren't coming in time, and you've got those interest only payments racking up on that other people's money that you're paying for. Boy, that'll make you squirm and sweat. So, if you use your own capital, you don't have that. Every dollar of profit stays in your pocket. No interest clock ticking while you renovate and wait for a buyer. You just wait for a buyer, wait for the right offer, take the offer that you want. And you don't have any holding costs other than the regular cost of taxes and insurance and utilities. Then you have full control on your exit. No lender can force your hand or tell you what to do. If the market softens and you want to hold as a rental, that decision is yours. You have peace of mind. For new investors, sleeping without debt is generally worth something. Learning on your own capital reduces that pressure. One thing that Richard Gamble did mention that I hadn't thought about, which I thought was a pretty decent idea. If you're new, and I have a lot of people that listen in that are new, if you're new to flipping, before you go borrowing other people's money, people that have worked hard for that money that's in their self-directed IRA account or their savings, before you go to private individuals, use the banks or institutional money or call me for a fix and flip loan. Um, Leverage that institutional money instead of using other people's personal money. Because when you're new, and this is a good point, you're going to make mistakes. So make those mistakes, but don't make those mistakes with your friends' money or people that you could meet for coffee, that you meet for coffee. Don't make your mistakes with their money. Start out using institutional money and bank money. Go through the process, learn how to do it. And the only way to learn how to do it well, I don't care how many gurus teach you how to do it, the only way to really learn how to do it well is to get started and do it yourself. Make your own mistakes. But if you use institutional money, it's just more of a piece to you because you're like, okay, I'm going to make these mistakes, but I'm not putting at risk people that I know their money. And then once you've done some flips, and maybe it's just two flips, or maybe three flips, then go talk to other people about using private money and private capital. So that's one thing to think about and that I wanted to point out. But if the honest case for cash is peace of mind, and if you're a newer investor and you've saved up the money to do the whole thing yourself, good for you. That was really hard. And that's just great. And then you're sleeping without debt is generally worth something. Lean on your own capital, it reduces pressure. But again, you're not going to go as fast. And you have to understand that. And that's okay too. So why do experienced investors still choose other people's money? Because the investors that I talked to, that I interviewed, they could use their own capital if they want now. They're not new anymore, right? They've got the money to do it and they can do it with their own cash. But is that what they would choose to do? Cash has hidden costs too. What happens when your cash is locked inside a house? Well, that means you can only do one deal at a time. Your capital is tied up. The next deal walks by and you can't move to it. You just lose it. You lose out on a good deal because your capital is all locked up in one deal. You've got slower growth. Michelle took years doing single deals before switching to other people's money and scaling up. You've got opportunity cost. Your cash is sitting in a house that earns zero while waiting for a buyer. Did you think about that? So, like Coco, Richard Barron's wife said, she said, I like to have my money invested somewhere else. Well, maybe she's got her money invested somewhere else with anywhere from 6% to 10% return. So her money's churning and making that uninterrupted compounding interest return instead of sitting in a house that's on the market and then that capital that's sitting in that house is not making any money. So your cash sitting in a house earns zero while waiting for a buyer. You have slower growth. You don't do one deal at a time. You've got the opportunity cost of locking up your capital in one deal. Scaling is impossible, really. You cannot build a business doing one deal every 6 months. You can make some money. You can make money every year. And that may be your goal. You're like, I want to use my own capital. I'm going to do 2 flips a year. There is nothing wrong with that. It's perfectly fine. But if you're of the mindset that, I really want to make this happen fast and I want to scale quickly, you can't do that with your own capital, or you won't go as far or as fast as if you leverage other people's, because cash is not using cash is not free. It has something called opportunity cost to it when you use your own cash. So the case for other people's money, what the experienced investors all agree: speed and deal volume. Borrowing lets you run multiple deals at once. Your cash works in one deal. Other people's money puts you in three or four. Or I know a really great flipper I could introduce you to that does 10, has 10 at a time. Your cash stays liquid if you use other people's money. You keep reserves for unexpected contractor costs, carrying expenses, or the next deal that needs a fast offer. So keeping your cash and reserves liquid is smart as well, because you never know what's coming. Either it can be a good thing or a bad thing. It can be an unexpected expense that you didn't see coming, which is a bad thing, or it could be a good thing. You see another deal and you want to take advantage of that. And if you have your cash liquid, you have enough down payment and reserves to do the next deal. A lender as a deal filter. Matt was right. If a lender will not fund it, that is a signal the deal may not pencil out. Use that information. Learn from that information. Ask that lender, why are you denying me on this deal? Talk to me about this, and listen carefully to what they tell you. So it's almost like if you're using somebody else's money and you're paying interest or points and interest, you know what? You're paying for their coaching, because they're going to tell you if that's a good deal or not, or what you should do differently. So you could think of it like, well, that's the price of paying for um, my education. I'll tell you too, you're going to pay for your education one way or the other. You're going to pay for your education in the mistakes that you make, or you can pay for your education and hire a coach that's been there and done that and is willing to teach you, and be so grateful to them for being willing to teach you, because it's not easy to be a teacher. I taught school for 22 years. I'm here to tell you, teaching is not easy. So if there's a person out there that has done 100 flips or so and they're willing to teach you, pay them and learn from them. Your lenders, they're kind of like a coach too, and you're paying for the coaching when you pay the points and fees, because they'll tell you if a deal doesn't work and why. So keep that in mind. And you're going to pay for your education one way or the other, whether it's in the mistakes that you make or in the coaching, whether that coaching be from somebody that's experienced that's teaching you how to do it, or whether that coaching be from the lender that's going to tell you this deal will not pencil out and here's why. Richard Barron, he made a good point. He said he doesn't want to pay for the coaching. He wants to make his own mistakes. He's like, bring me the mistakes. He's like, let's get started. I'm going to go ahead and make my mistakes. And I love that, because that is definitely a way to learn. I wouldn't say either way is right or wrong. Jump in there and make your own mistakes and pay for it, or pay for a coach and avoid some of those mistakes. Both are great. I think the wrong thing to do is nothing. So if you really want to do this, you need to get moving and just be ready to make the mistakes, or hire a coach that will keep you from making some of these common mistakes. Build a real business with other people's money. Michelle Winberry, once she started using other people's money, she went from occasional flips to a sustainable, repeatable operation, and they've done over 100 flips. So keep that in mind. Other people's money can turn an occasional flip into a business model. How fix and flip financing works, it's simpler than most new investors think. It's really not that complicated. You find the deal, run your numbers. You've got your purchase price, repair estimate, your ARV, which is after repair value, and your target profit margin. Don't forget to pay yourself with a margin. Okay. Um, Make sure you don't overpay for the property, that your purchase price is reasonable. When you estimate your repairs, if you're a newbie, either pay that coach to help you do that or bring in an experienced contractor that will help you do that. And I can put you in touch with either a coach or a contractor to get that repair estimate right because you're going to underestimate it. You're going to underestimate your repairs. You're going to spend more money than you think. So do your very best to get that scope of work that's a repair estimate correct. Look at that after repair value. Um, I have some ideas for you that I'll share on how to nail an after repair value and get it right, but you want that number to be right. Because if you overestimate what the after repair value is, it's going to eat into your margin, your profit. Okay? And don't forget to pay yourself. Don't forget this is your time. And time is the one thing that is the most valuable to you. You can't replace it. So keep that in mind. If you're going to do a flip, you need to get paid. So make sure you don't overpay. Make sure your repair estimate is accurate. Make sure your after repair value is correct and that you reach your profit margin. That's your goal, is your profit. Then you're going to apply for a loan. Your lender reviews the deal, not just your credit. A good lender looks at the property and the numbers. A good lender is going to be, you can come through me and we can do that through institutional money, or it could, mortgage broker. I'm a mortgage broker. Or you could go to a private money lender that funds these deals. But that lender is going to look at the property and the numbers. And you just apply for the loan. You get approved, then you close and renovate. Funds are typically released in draws as work is completed. I can tell you more about that. We'll have another webinar about that, how that works. And you manage the project and you get to work. You get up every day and you get to work. And then when it's finished, as quickly as you can get it finished, you sell it and you repay your lender. At closing, you repay the loan plus interest. What's left is your profit. And I can talk to you about any of these stages, 1, 2, 3, or 4. I have ideas for you on each one to make it flow a little bit smoother. On the sell and repay, I can help you with that. I have some ideas for that. Can refer you to a good realtor. Um, we can talk about that. We can talk about how draws are released. You have to have some money put aside. We'll go into more detail at another webinar, but you got to have some money set aside to start your project. And then as you go through each phase, you get refunded that money. Know these things before you talk to the lender. ARV, that's your after repair value. The estimated sales price once renovations are complete. This is the number your lender uses to size the loan. Loan to value. The loan amount is a percentage of ARV. Most in fix and flip lenders will go up to 65 to 75%, some up to 90 loan to value. So this is the loan amount as a percentage of the after repair value. Hard money, short-term asset loans, these are best for investors. They're faster approval than banks. They're higher rates and shorter terms. They're built for flips. If you want to get started, hard money is a great way to go, and I can help you with that. And it's pretty fast approval. Get started. Then there's the draw. That's a release of renovation funds at a project milestone. You do not get all of the money up front. It's released as work is completed. So I've had newbie investors not understand this. So for example, if on your scope of work, you have repairs on the kitchen listed at $10,000. Good luck keeping it and $10,000. But anyway, just for simple math, you've got $10,000 to repair the kitchen. So you have to have $10,000 to pay for that. And then once it's done, you submit pictures or whatever the process is to the lender, and the lender refund. They give you a draw, or you take a draw that pays back that amount on the kitchen. And then you move on to, say, a bathroom, and you do the bathrooms. And then you move on and you do each piece of it as you go, and you get reimbursed as you go uh, throughout the project. So you have project milestones. Points, these are upfront fees charged by the lender. They're typically 1 to 3% of the loan amount. A cost to factor into your deal numbers. And I wouldn't feel bad about it. I've paid them. Fix and flippers pay them. We all pay them. The points need to be paid. Again, you're paying for the use of somebody else's money, and also for their pretty much for the coaching that you're going to get, because they're going to tell you how to do this and what they will and won't fund. And just factor that into your deal. Make sure that you don't forget to factor that into the deal. Remember, you want that profit margin. So make sure you put that in there when you're figuring out how much you're going to pay for this property, that you're going to have to pay for these points. What a lender actually looks at, it's not just about your credit score. Sometimes investors think, well, it's just my credit score. I have a great credit score. That's not it. That's not what matters the most in these situations. What matters most is the property and its after repair value, your repair scope and budget, your exit strategy. Are you going to sell it, or are you going to refinance it and hold it as a rental? Your experience level. How experienced are you? No, if you're a new investor, you may be charged a little bit more. Don't be sad about that. That's okay. You're just paying for, you got to pay to play here. So your experience level matters. Skin in the game. How much money are you going to have in the deal? You know, if I'm privately funding a fix and flip for you and you've got 50% of your own money in the deal, well, I may back off on my interest rate a little bit because I know you have so much skin in the game, it's less risk to me. Remember at the beginning, I said lenders set their interest rate based on their risk to them. So if I'm your lender, or your private money lender, and I see you have 50% of your money in this deal, that's low risk for me. So I may back off on what I would charge in interest in that case. So your skin in the game matters. Your down payment matters. Um, if you're working with me, what I would do a little bit differently is I want to explain your options to you honestly. If I think we're talking and you're asking me, I would never give you unsolicited advice. But if we're talking and you're asking, and I may say to you, well, in your case, maybe it's better to use your own cash. Maybe it's better that you, in your case, use your own capital. And I will tell you that. I'll also review your deal numbers with you and talk about it. And because I have done this, we'll probably continue to do this on some level. Fix and flips. I mean, I've been there and I've done that, and I'm happy to review it with you. And if something is over my head, I'll refer you to somebody that will help you, get in more detail. And I'll tell you if the deal doesn't work. And I help first timers understand the process. And I'll stay in your corner after closing. I really like first timers. I love that. You're just anxious to get started and excited. I'm happy to help those people that are just getting started. Cash versus other people's money, side by side. Interest cost, your own cash, no interest. Other people's money, yes, there is interest. It's hard money. You need to factor that into the deal. Factor speed to close. Your own cash, it could be slower because you have to save up the money. How long is it going to take you to save up that much cash? Other people's money can be faster because then you only have to save up your reserves and down payment and closing costs. So you can go faster. Deals at once, your own cash, you can only do one at a time, maybe. Other people's money, multiple is possible. Definitely possible. Cash reserves, if you use your own cash, it's locked in the deal and you might get caught using those credit cards. So keep that in mind. Be careful about that. Stay out of the credit card cycle if you can, of getting trapped with them. Other people's money, cash reserves, your reserves, they stay liquid. You have control on the exit with your own cash. You have full control. On the exit, if you have other people's money or hard money, the lender has input and can tell you what's going to happen. If you have your own cash in a deal and you're like, this house is not selling, it's not on the market, now winter's coming. Well, if you have other people's money in the deal, the private money lender or the money lenders might say, time is up, sell that property, and you have to sell it at a discount and cut your margin. Or if it's your own cash, you might say, I think I'll just let it ride out through the winter and hold it, and I'm going to sell it in the spring. But you have control over that, right? You get control of the exit. Best for your own cash is best for learning. It's best for smaller deals. Like Matt said, if he's just doing a smaller deal, it's just easier. He might just use his own capital, and that's fine. Your own cash it is better for learning too, honestly. Or maybe just use institutional money and not private money lenders as you're learning. Hard money or other people's money is best for scaling. It's best for doing the bigger deals. If you're going to move into this, big numbers when you're doing deals, You're going to need to have relationships with lenders, either private money lenders, mortgage brokers, bankers. Um, to scale, you're going to need other people's money for the bigger deals. Many new investors want to talk about Dave Ramsey, or they'll ask me about this all cash. And I love that. I love that young people, I'm noticing young people are talking about this more now. Maybe it's just because we're the age my children are, we talk about it. But what about Dave Ramsey's idea of, cash for everything, and cash is king? All debt is bad. Debt is terrible. Okay, he's not wrong. And Richard Gamble, we talked about this, or he talked about this, and I like how he takes on it, how he thinks about it. It's not wrong to think that way. That's fine. If that's what you want to do, and that's how you want to operate your business, and it's great for personal finances. No debt personally. Keep all that debt off of your personal. Keep your business and your personal separate. Get all your personal debt paid off. Absolutely. But the all debt is bad view, maybe not so much. Um, Pay off everything before you invest. Never borrow to buy real estate. Cash only gives you peace of mind. Maybe in personal finances, but how long would it take you to get absolutely everything paid off that you would ever need and save up enough money to do your first flip if you're making a regular salary? And how do you get that salary increase? Like, you're just like, what do I do here? I can't seem to get ahead. So the investors think about debt differently. Okay. Debt is used to produce income. If debt is leveraged to produce income, it's different. A fix and flip loan exits in 90 to 120 days. It's not a 30-year amortized mortgage. You're in it, you're out of it, you pay for it, and you're done. The profit far exceeds the interest cost. So think about interest when you're borrowing money, other people's money, or you're using me for a loan, or you've got a relationship with the bank, or whatever you're doing. Think of that interest in terms of volume instead of rate. Think about it in terms of how much interest did I pay on the deal. Try to not get emotionally involved in interest rate. Just think about what was the volume of interest I paid on the deal. Write that number down. Then write down your profit, your margin. What did you make on the deal? If the profit far exceeds the interest cost, that's good for building a business. As long as you're making money, and you're making a lot of money, and you're paying that back, that's how you move further faster. And that's how you leverage and move forward. So investment debt and consumer debt are really not the same thing. So the interest cost on a short flip is small compared to what your cash earns doing nothing. Time is the real currency. And the investor who can close fast and move on to the next deal wins. Okay. The interest cost on a short flip is small compared to what your cash earns doing nothing. So, you're making that margin. Well, if your cash is in the deal and it's not doing anything, it's not really working for you. I think back to Coco when she was saying, invest your money in something and use other people's money to do your deals. So your money is growing while you're using other people's money to do your deals. Typical hard money interest on a 4-month flip is, well, we'd have to analyze the deal to see how much it was, depending on what you were paying. You can do 3 times more deals per month with other people's money versus 1 deal per year with cash. So here's what we all agreed on. And this is not me speaking, it's just some experienced flippers. I haven't done 100 flips, so I knew I didn't need to be answering this, but I thought it was interesting to talk to these experienced flippers from different areas and see some of the things they all agreed on. They don't even know each other, some of them. Richard and Richard know each other, but Michelle and Matt might kind of know of each other, but for the most part, they don't talk regularly to have the same ideas. They come up with these ideas on their own. So know your numbers before you borrow. Know your numbers. Never guess on an after repair value or repair costs. Don't think, oh, well, I walked through the house. I think that the repairs will be $50,000. No, you need to do a scope of work. I will send you a spreadsheet. Call me. We'll get you straight. You have to know your after repair value and your repair costs. The deal has to make sense on paper first. Financing is just the tool, not the plan. So don't focus on the financing. Focus on that deal. Paper it out. Call your mentor that you're paying for coaching, or do your best to do it yourself, and then see what the lender thinks about it. Your lender should feel like a partner, not just a money source. Honesty matters. Your lenders are not just transactional, okay? They are in this with you, and you need to feel like they are in it with you, and you need to talk to them and trust them, and have a good dialogue with them, and not just call up some stranger or whatever, or do something online to get lending or financing and you never had a conversation. Your lender should feel like a partner. Starting with cash to learn is fine. Just know that staying cash only to scale is limiting. It's going to limit you and how fast you can go. A good lender who understands flips will help you save you money and not cost you money. And don't get hung up too much on an interest rate or I paid interest on that. Focus on what was your profit in the deal. What is your profit on the deal? If you want coaching for fix and flip, I'm not qualified to be a fix and flip coach because I've not done 100 deals. I can refer you to Michelle Winberry. She can talk to you about it. Richard Gamble, he has coaching for fix and flips. He offered to share his phone number here, or you can reach out to him on Facebook. He'll be honest. He'll tell you what he thinks of the deal, um, and he can help you choose what fits your situation. He's so experienced and has helped so many people at different levels, from first flip to portfolios. So I can give you other referrals if you need them. That's all I got for today. And thanks for coming. And I hope it helps somebody. Talk soon.